Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall with Dominion. We're a specialty tax and accounting firm specifically for financial advisor practices. And I am very excited today to have on the show with me John Turner. John serves as a VP for Investment Advisory Lending at Live Oak Bank. John joined Live Oak with over 35 years of experience in the financial services industry. So he understands you guys very deeply. And over the years, John has garnered experience by buying, brokering, or financing over 600 deals in the space. So thanks for joining me today, John. We're going to have a very nerdy conversation about deals and deal structures and taxes and all this, that, and the other. So thanks for coming on.
It's a pleasure to join you, Catherine. And I'd say, 35 years, I guess the other answer to that or the other introduction is I'm old. So you collect experiences like barnacles. That's kind of how that works. So now you get to hear some of it today.
Yeah, no, that's great. And I think I always get these questions from advisors. I always get them, it's funny, like I'll have them reach out and say, hey, I just, somebody just told me they'd pay me a 5x multiple, or they'd pay me a this X multiple. And I've seen some like crazy figures recently from some acquisitions. And it's really interesting to see those, because I know a lot of the time there's a kind of disjoint between what people think, what advisors think their practice is worth versus, well, how are you actually going to get this through a deal? And then what are you actually going to get on the other side of this, once it goes through the dreaded tax funnel? So I guess,
it is one of the most misunderstood things out there is what my practice is actually worth. So we're going to be talking a little bit about that today.
Yeah. No, that's great. Yeah. So in terms of the, most common things, like let's just talk about, kind of pre-deal early on in the relationship. What are things that you commonly see advisors miss, when they're getting, say we're talking about maybe like 5 years out from considering doing a purchase, or okay, I want to sell my practice. What should they be thinking about in kind of that pre-game phase? And then maybe we can just kind of talk through the progression of as they hit the different phases of, going through a transaction like this.
Absolutely. Well, and the track's a little different, whether you're a buyer or seller. So we'll probably kind of start with buyer. A couple of very, very important things is if you think you're going to end up using bank financing or third-party financing, time to really think hard about how do I make myself more bankable?
Yeah.
And I always tell people, Catherine, that revenue doesn't pay for deals. Profit pays for deals.
Yep.
So how in the world do you boost your profit? You need to be pretty rigorous looking at your expense structure. Now, you don't want to compromise the client experience, but you want to be ruthless with any of those other expenses, because you need to have profit to get into deals. The other thing, of course, are things like improve your credit score, make sure it's good and strong, at least 700. Make sure that you've got a good personal financial situation, because that's going to be taken into account as well. So just getting bankable is super important. That's to be attractive and winsome to the bank. Now, how do you be attractive and winsome to sellers? Because it's kind of a competitive world out there.
Yeah.
We talk about the 5 C's. So first one is, everyone guesses, it's cultural fit. Do you have a similar value proposition? Do you have a similar client demographic? All those kinds of things. The next C is capacity. Do you have the capacity to take on all those clients and serve them well? How do you demonstrate that to your potential sellers? So are you going to talk about workflows? Are you going to talk about your human capital strategy, where you've got the right people in the right chairs with the right skills? Are you going to talk about your technology that you leverage and how easy that makes that? We were just talking about AI. That's becoming the thing. So how are you leveraging that to get capacity? Next C is capability. Do you have all the intellectual horsepower required to deal with the most difficult case in that book? How are you going to demonstrate that? Is that alphabet soup after your name? Is it talking about a difficult case you've done? And then the next C is character. Are you a person of honesty and integrity? Check this out, Catherine. September 29 of 2022, an article came out where an RIA had sold his practice to another firm. And 3 years into retirement, living his best life, 3 years in, the long arm of the Securities Exchange Commission came in. Why? He sold to a top bidder, and they happened to be a Ponzi scheme. And so the SEC said, when you go to sell your practice, you have a fiduciary responsibility to place those clients in the hands of a high caliber, high quality person. So as a buyer, how are you going to demonstrate that? And then the last C is capital. When the money gets real, the deal gets real. On the seller side, very quickly, boosting the value of your business. Obviously, the more recurring you have, the more value you have in your practice. One that gets missed a lot, though, is this. One of the single largest discounting factors in your book will be revenue held by clients age 70 and a half and older. And frankly, by the time they hit age 80, if you don't have the heirs in the book, it looks more like commission revenue. It doesn't get a whole lot of value attached to it, unless you have the heirs in the book. Then it could be a premium because there could be potential windfall. So I always tell folks, when you look at your client segmentation strategy, a lot of your C and D clients might not have a lot of revenue, but if they are the heirs of your larger clients, they might not build revenue, but they build equity. They build value. Your final paycheck will be much higher. So making sure you have those folks in your book, very, very important. Making sure that your book is transferable. A lot of people think, gosh, I should custom make all my investment recommendations and custom make all the analysis that I do. The more you can make that streamlined, because really the value is, I'm talking to the advisors, your ability to manage that relationship. That's where the value is, not in things that you could systematize and make it easy to transfer. You make it easy to transfer, you're going to get much more value for your book. So those are the things that I think about when you're going through. And kind of the flip side for the buyer too is how do you vet, for the seller, how do you vet your buyers to make sure that you're getting one that can pay you and has the character that you're looking for and all those things. So kind of the opposite of the 5 C's. You need to test for those 5 C's if you're a seller. You need to be prepared to do it.
Yeah, no, that's really great feedback. And, something that I always talk to advisor practices about, pretty early on is if they don't have formal exit planning in place, that's, even if they're not planning an exit anytime soon, it's just good to have some exit planning done like that, because all of those pieces that you're talking about, this shouldn't be the first time that they're hearing about this, right? Like if you're really trying to build up the asset that's the practice, and you've worked your way up from, I think a lot of people start in the industry like this. You work for somebody else. Maybe you are a forward-facing advisor. You're a technician. Maybe you read, E-Myth or something, and then you get bit with the entrepreneur bug, and then it turns into, actually, my real job is managing this whole practice and managing this asset and building it up as an asset. And so I love to have this conversation early with advisors of like, okay, I know you're 10 years out from a sale, or you're 10 years out from formally doing some succession planning or equity exchange, but can we do exit planning now so that you can figure out the pieces that are going to unlock the most value in the business, because it's going to make you more attractive to a seller, but it's also just going to make the business better to run. When you can break down those pieces of, how to make this more attractive to an outside person. For advisors that you've seen, I think more commonly what I've been seeing, I see a mix, right? Like I see people where they're doing outside acquisitions. There's a lot of risk there in terms of, they don't, the person's a stranger, like you don't know them. You don't know if you're selling, you don't know that they're going to take care of it's hard to get assurances on all those pieces. So I see some of those kinds of transactions, but I think what I'm seeing fairly commonly too with a lot of practices is their ultimate succession planning is really about getting second generation advisors in, having them raise up within the firm, and then doing kind of like a soft landing exit in terms of doing something more like an installment sale. It's like more of like an arm's length transaction, just because they have a relationship with the advisor, and it's almost more like a family transaction. In those kinds of deals, have you, in terms of on the financing side, because that's a huge component of it, is sorting out the deal structure to make sure that the financing is going to work out for G2. What are some things that you've seen for, what's made those work better, or things that, maybe advisors aren't thinking about when it comes to those kinds of transitions?
Absolutely. And frankly, those, to your point, those are the sweetest kinds of transitions, because it's not disruptive to the clients. It's very seamless to the clients. And it really kind of helps having that next generation, because frankly, they put the shoulder to the grindstone. And they really grow the place for you. Your buyer is building your value. It's an amazing thing to watch. We do see a lot of those, and I think
Mm-hmm.
we see more than our fair share because we're the only bank that I'm aware of that will not put the senior advisor on the loan. So they
Mm.
are footloose and fancy free. They can take money off the table, and then they can do that. So there's a lot of things that you need to do for that. I think you need to prepare your business. You need to prepare that junior advisor. You need to prepare your clients, as well as prepare your staff. So let's
Mm-hmm.
talk about each one of these for a moment. Um, Preparing your buyer, your G2, we call it generation two. Seller is generation one, buyer is generation two. You need to really make sure that they understand profit and loss. In fact, your profit and loss. They need to understand the business because if I didn't mention it, profit pays for deals. So it's
Yep.
important that they really understand how that works. Also, I think it's very, very important that they understand all of your processes in your business, not just the ones they've been working, but
Mm-hmm.
globally, what are the processes, that they're now going to be accountable for? Super important that they understand that. They need to get themselves prepared financially. So again, they need to make sure that they have a good credit score, that as much as they can, they have a good personal financial statement, a strong one in place.
Mm-hmm.
That they have, that they have good kind of character points that they can talk to. Super important. Another thing with the G2 is leadership, because oftentimes as a generation two, they were part of the team.
Yep.
Now they're going to become an owner. They're going to become a partner. They may have to start leading staff. And if they haven't had any sort of leadership training, that can be a hot mess. So really important that you ensure that they can be great leaders of people as well.
Mm-hmm.
And which kind of brings us to the staff. On staff, they can either be the best ally that you have in this, or they can become the greatest saboteur. And
Yeah.
they've seen this G2 person, they've seen them stub their toes, they saw them as the young person coming in, and now they're going to be my boss. So really making sure that you've worked on the change management aspect with your team is super important. Same thing with clients, and particularly if they're going to take over key relationships with clients. I used to do a lot of practice management, Catherine, and we were doing a client advisory board, and
Mm-hmm.
this G1 was going to be handing over some clients to the G2 as part of this percentage purchase. And the clients would just not have anything to do with it. They said, wait a
Mm.
minute, we came to you. We're part of this practice because you're our advisor. And you're generation two. I'm sure they're a very fine advisor, but they're not you. And we thought we were dead in the water, and we kept talking about it. And the message that then came to be most effective with these precious clients was the conversation of, oh, I'm not going away. You used to have just my intellect to work on your case. Guess what? Now you're going to have two brains working on your case. And by the way, no extra charge.
Mm-hmm.
That rang with clients. But you have to think about, clients, how are they going to take this? What kind of messaging do you need to have in place for that? And those kinds of things. And then as the G1, you need to prepare yourself because,
Mm-hmm.
again, you used to be the only one potentially calling shots. You might be in a partnership. There may have been just a couple of you calling shots. Now you've got a new player that's going to be at the decision table. Now, they might be a minority shareholder, but they're going to have an opinion, and
Mm-hmm.
they're going to be younger. And it might be very different than you. And even if you have a partner, you're partners. So you need to be kind of prepared to be flexible and find a way that they can get their opinion into the decision making process as well.
Mm-hmm.
And lastly, I would say is you need to prepare your agreement. So time to look at your operating agreements. Do you have really strong restrictive covenants in place, and some of those things as well? So there's a lot to do to prepare, but it's totally worth it to
Mm-hmm.
really look at bringing in that generation two and do it
Yeah.
in a kind of a percentage stock purchase way.
Yeah, and I guess in terms of, maybe some stories, and not necessarily that we need to put figures to things, but just to give people kind of some things to latch onto. Are there examples that you have of some of these kinds of transactions, just like how the general deals went and, what worked,
Yep.
what you've been seeing in terms of, hey, we had an advisor, this was roughly what was going on, and this was how we made the deal happen, and, some of those scenarios for people to kind of keep in mind. Because I had an advisor the other day tell me, he was like, we financial advisors are like the most lonely people because we won't tell each other, what's going on
Mhm.
internally with our own practices, or like we're very guarded with, it's one thing when you can pull somebody's ADV, but it's like, which I've done from time to time. But in terms of actually telling some like battle stories, are there any ones that kind of stick out to you as a good example of these kinds of transitions and just what actually happened? Just a slight interruption in this conversation. I wanted to bring to your attention two things that are important for you to know. So we're always at the mercy of social media algorithms. So if you can subscribe to the show, that would mean a lot to me. Even more to me if you can leave a rating and let me know what you think about it. But we have a new newsletter that's coming out. It's going to be very active in 2025. That is specifically around tax issues that I'm seeing advisors face in their own practices, changes in legislations, and the pieces that I think are critically important for you to stay ahead of as an advisor with the new administration. So nearby, wherever you're interacting with this, will be the link of how to sign up for our newsletter. Also nearby will be the link to my LinkedIn, which is the best way to get in touch with me, learn more about what we're doing for advisors in the tax strategy and compliance work that we do, and also to get access to the various tools and interviews and things that I do, specifically designed to help you improve your practice, improve your own tax situation, etc. So let's get back to the episode, and thanks for tuning in.
The saddest and yet sweetest one I think of was a firm in Hawaii. And originally, again, a lot of times you'll see these partial stock purchases. They were driven for one of four reasons. Either the G1 just wanted to get some chips off the table, just get some money out of the practice, or they wanted somebody in the boat with them. Like I said, they were kind of lonely, or it was part of a longer term succession strategy, or what really gets driven in the market a lot these days is retention. It's a human capital strategy because nobody calls their own baby ugly. So what do? Let them make it their baby.
Yeah.
This was one of those instances where they were really selling not as part of a long-term succession strategy, but more of would like to keep them around. So basically had sold, the firm was worth about $5 million, and they sold 10%. So the G2 acquired 10%, $500 million. We did the financing for it. By the way, we go 10 years on that. So you're going to actually buy in and still buy Christmas gifts for your kids. So
yeah, no, that's a pretty sweet setup.
It is. What made it sad and sweet is that the G1 came up with brain cancer and had to have a third of his brain removed, like right off the bat. But here's the thing. Thank goodness he hadn't intended it to be this way, but he had somebody in, first off, who was willing to put their shoulder to the grindstone because they owned part of it.
Yeah.
But also there was a track for them to run on to buy out the rest of the practice, and of course it got accelerated. But the point too was that the clients got well served, the spouse was provided for, and he really had no worries about the business as he entered this final stage in his life. Now imagine if he would have had to start from scratch with a third of his brain missing. How do you do that?
Yeah.
So I think sometimes, this isn't meant to be a Debbie Downer, right? But, you always want to, especially if you're old and ugly like me, you might want to start looking for somebody a pathway for you to get in. And I still think, the sweetest pathway is looking at that generation 2. And if you don't have one, go get one. But looking at that generation 2 and looking at, how can I invest in them and how can I move them into entrepreneurship? I think it can pay off in spades for both of you.
Yeah, absolutely. No, and that's a big conversation that I have often with clients is what's your contingency plan too, of just, okay, if something happens to you, like, is there somebody, especially if it's like a solo practice where it's just kind of one head advisor who's running everything, more like a lifestyle practice. Is there somebody else in your office? Is there somebody else that you can have some kind of agreement in place so that if something happens, you have a contingency plan where the clients are cared for. And then also if you've got, a widowed spouse now, it's making sure they're going to get, they're not going to be stuck with this, advisory firm that they don't know how. It's like, it's not their background. Like, how are they going to know what to do with it in the midst of grief? Which is, it's just a double.
Well, it's even worse than that. We'll get off the Debbie Downer point here in a moment, but you want to guarantee yourself at least a 30% discount on the sale of your practice, wait till you're disabled or dead to sell it, because
Yeah.
you're not around to make the introductions.
Yeah.
So that risk of attrition has to be priced in, and it's generally at least 30% discount.
Yeah. Oof.
So, bring in that G2, sell them a portion of the business already. Be prepared. Even if you've got a buy-sell agreement, if you're dead, there's still no one there to make the introductions. It's probably going to go at a discount. So, kind of
Yeah.
keep that in mind.
Yeah, no, that's a good point.
Yeah.
Well, on happier notes, what are some
Good.
what are some examples of some deals that you've seen go right, in terms of what people were able to do, and maybe some cases you've been involved with that you think are a good example for advisors to keep in mind as they're going through this, in their own practice.
Yeah.
Maybe we can talk a little bit from the the acquisition standpoint. So like I have a number of clients where they're in acquisition mode. Like I had a conversation earlier this week with an advisor who's, voraciously trying to find other advisors who are getting close to retirement and finding a way to have a clean succession plan. He wants to be their succession plan, and he's built a really nice platform for it. So for those style of advisors, what have you been seeing in terms of, deals more on that side, maybe on the acquisition side for people?
Yeah.
How that's worked out.
What it's kind of interesting you bring that up. So probably one of the sweetest ones we had was, and this isn't for your small practices. This is for practices that have 2 million in EBITDA and greater. But we do these things called delayed draw term loans, where you do one big underwriting for a pipeline of deals you plan to get done in the next 18 to 24 months. And then you just go out and acquire. And you actually start to look like a roll-up firm, but you didn't have to dilute your equity in order to do it. You use lending instead. And, we've the ones that we've done, they have always come back for more, because once they get into a rhythm and once they get out there in the marketplace, the people start coming. Deals beget deals. If you treat the seller well, if you've listened to them and you've helped them figure out what their ideal transition is, and if you've treated them as your number one planning client and you help them achieve their retirement goals, that gets out. And like I said, deals beget deals. So those have been the most successful ones I have seen. And I'm thinking of one in particular, and I won't even give you the location because of confidentiality, but he was, when we started working with him, he was a sole prop, and he now is I think a $300 million revenue behemoth.
Nice.
And just going to town. Yep. Mostly through, acquisition. So I've seen that, quite a bit. It's interesting. We did a research just on acquisition. We did a research project. We were trying to answer the question, what kind of attrition should you experience when you purchase a practice? And so we did a 3-year longitudinal study. So let's say you were buying in 2013. We looked at the seller's tax return company out of it. We then compared that to 14, 15, and 16 actual taxes of the buyer. And we did that. If you bought in 14, we looked at 15, 16, 17, and so forth. 3-year longitudinal study. What we found, in fact, we couldn't go with the average because it was so outrageous. It was a big number. No one would believe it. So we went with the median. The median growth rate over those 3 years was 58%.
Wow.
50, right. So we dug a little deeper and figured out what in the world was going on. Well, there was kind of two things. One was, it's sorry if you're a seller, but the sellers had retired in place.
Yeah.
They were taking Mondays off. They were taking Fridays off. So retired in place, RIP, think little tombstone, RIP. And then here comes the buyer, PhD, poor, hungry, and driven.
Yeah.
And they actually come into the practice, and a couple of things happened. One was they actually found money. I mean, there was that D client that was a D client 10 years ago, but it's been 10 years since you actually really connected with them. Turns out they're an A client. So things like that were happening all over the place. And then the other thing that was happening was, fortunately, the seller looked like me, old and ugly. And they were getting the question about, well, when are you going to retire? And, you'd have to come up with an answer. When are you going to retire? Here comes that PhD. They look young. They look sharp. They look competent. They look like you, Catherine. And by golly, there's something to refer into, something to make a reference into. So referrals cropped up in a big way.
Mm-hmm.
Now, here's the crazy thing. We took a look at it by gender as well. Now, we
Mm-hmm.
didn't have a lot of female buyers, but the ones that we had, their growth rate was 97% over the 3 years.
Wow.
And we
Yeah.
dug just a skosh deeper. And what it was it looked like they were more conversant, that they just
Mm-hmm.
talked to the new clients more and more often and were more reassuring. That seems to be the difference from what we could see. So so yes, there's all kinds of growth stories out there. There are a few nightmare scenarios that we could talk about, when
Mm-hmm.
doing acquisitions, but for the most part, it's sort of a growth thing. So a lot of times, I'll say this: potential buyers will go, "Well, gosh, is it organic or inorganic? Which way should I go?" And
Mm-hmm.
I'm like, "Well, don't do both. Don't stop doing either.
Yeah.
Do your organic activities now on a much bigger farm field, a much bigger audience that you can work with because you purchased. So you
Yeah.
don't stop doing organic. You just apply it to a bigger audience.
Yeah. Yeah.
Yeah.
Absolutely. Yeah. And I've seen with like a lot of the, it's definitely a mindset change, if, for people who are interested in getting warped into this mindset. If you check out the book 10x is greater than 2x,
Mhm.
that's like a gateway I've seen a lot of advisors go through, which is a great book. I've read it. I really liked it.
Yep.
But I think when they change to that mentality of, oh, my firm is actually a platform,
Mhm.
and if I build it out as a successful, efficient platform for this service delivery to go well, then
Mhm.
I can acquire other practices and get them onto my platform. And I'm going to immediately get that, like you're saying, those crazy growth numbers, just
Yeah.
because I've built an internal, it's almost like a franchise. Like I've built an internal
Mhm.
system that works,
Mhm.
successfully. And if I can do these deal acquisitions, it just turns into, basically
Mhm.
a lot of it, there's a lot of culture fit and things like that too, but it's, it turns into just a math problem,
Mhm.
in terms of like the cash flow forecasting and all of those pieces. So
Yeah.
that's very interesting to hear some of those statistics. I know for today we'll have to do a Halloween nightmare deal episode
I'll get the
later this
flashlight. I'll
year.
hold it underneath my chin and
We'll get all the spooky lighting and stuff for deals gone wrong. But
oh yeah.
so for advisors who are, okay, they're very interested in learning more and kind of getting deeper into the weeds. What's the best way for them to get into your world, John? And what are some maybe closing thoughts that you have
Mhm.
that they should take away from this conversation? Any action items you think they should take away today?
I think a couple of things. First off, again, just to recap, if you're a seller, you want to boost the value of your business, prepare. And prepare, to your point, Catherine, 5 to 10 years out if you can.
Hmm.
If you're a buyer and you want to be winsome and attractive to a bank and winsome and attractive to sellers, prepare.
Yeah.
So, and we've talked about all the ways to do that, and there's even more. If you want to get in deeper into this, if you go to www.liveoakbank.com and then you click on loans and go down to investment advisory, we have about 35 industries we specialize in. So look for investment advisory. You click on that, we have a bunch of resources there that
Hmm.
will help you do that. The other thing is, give me a call. You can call me at 651-212-0141. And Catherine, I always tell folks, you can come to us too late and you want to wig a seller out, create a deal structure, and then have to unwind it because it's not quite bankable.
Yeah.
So you can come to us too late. You can't come to us too early. I've had folks that have come that just want to kind of get into the game and
Yeah.
want to talk about, for example, how to source sellers. We can
Yep.
definitely talk about that. So I'd say those are the two avenues at the moment that I'd recommend if you want to
Hmm.
get a little deeper into this. And plus, Catherine, any resources that you would have as well that you would recommend, I'm sure they can connect with you too, and you can point them to some folks.
Yeah, so we're in the process of hopefully by the time this episode goes live, we're brewing up some additional webinar and
Mhm.
content related to buying and selling of practices, because it's just I've seen it just blown up with a lot of the advisors that we're working with and the issues they're encountering, and there's not a lot of good education resources out there in my experience, especially on the tax side. So it's definitely something we're in the works on. So people who aren't connected with me on LinkedIn, you can connect with me there. And also, we're doing a newsletter where we're expecting a lot of legislation updates in 2025. So we're going to be covering a lot of that in addition to, as I do new webinars and continuing ed. And there's probably a number of conferences I might be speaking at next year on different
Excellent.
topics. Like doing that sort of thing. But I want to thank you for coming on, John. We'll have to do a follow-up. There's so much more to talk about here. Like we didn't even get into, different financing terms and things like that. So we'll have to do some follow-up episodes. For
Absolutely.
people who are listening, if you have specific things that you would like us to cover in a future episode, feel welcome to send me a message and we can get those episodes coordinated for the things that you are finding to be the most pressing, in your practices these days. But I want to thank you again, John, for coming on the show. I appreciate you taking the time.
It was an honor to be with you today.
Yeah, likewise. So for those of you listening, we'll post the links nearby. We'll post John's phone number. So give him a call and make him regret putting that out in the ether. And then we'll post the link to specifically on Live Oak Bank's website, where you can get the information for the investment advisory, practice focus that they have there and the resources there. I know you guys put on great webinars and things too. So I hope people take advantage of, getting to know more into the weeds and that sort of thing. But so thanks again for coming on, John. And for those of you listening, this was another episode of the Financial Advisors Want to Know podcast.